The market does not destroy traders. Traders destroy themselves, and most of the time the destruction does not come from a bad entry. It does not come from a weak strategy. It comes from something far less exciting and far more dangerous: position sizing. Jesse Livermore understood this long before modern trading platforms existed. He knew that being right was not enough. He knew that timing was not enough. The size of the position determined survival, and survival, in the market, is everything. Most traders focus obsessively on entries. They search for perfect setups. They test indicators. They refine strategies. But very few ask the most important question before entering a trade: how much should I risk? Livermore believed that preservation of capital was the first rule of speculation. Not profit, not prediction. Preservation. Because without capital there is no second opportunity. The tragedy of retail trading is simple. When traders feel confident, they increase size. When they feel fearful, they reduce size. Position sizing becomes emotional instead of mathematical. The market punishes that inconsistency immediately. Livermore approached position sizing with cold discipline. He did not bet heavily simply because he felt certain. He increased size only when the market confirmed his thesis. He pyramided into strength, not weakness. He pressed winners, not losers. This distinction is critical. Most traders do the opposite. They average down. They add to losing trades to improve their entry price. They convince themselves that the market is wrong and they are right. Livermore warned against this behavior repeatedly. He believed that adding to a losing position was the fastest way to financial ruin. Position sizing is not about confidence. It is about probability and risk tolerance. Every trade carries uncertainty. Even the most perfect setup can fail. The only variable a trader truly controls is the size of exposure. That exposure determines emotional stability. When position size is too large, small fluctuations feel catastrophic. The trader watches every tick. Anxiety rises. Decisions become reactive. Stops are moved. Profits are cut early. Logic disappears. When position size is appropriate, the trader can think clearly. Temporary pullbacks do not trigger panic. The plan remains intact. Discipline holds. Livermore understood something profound. Emotional control is directly linked to risk size. He often said that the big money is not in the buying or selling. It is in the waiting. But waiting becomes impossible if the position is oversized. Oversized trades create urgency. Urgency destroys patience. Position sizing begins with a simple calculation: how much of total capital can be risked on a single idea without threatening survival? Professional traders rarely risk more than a small percentage of capital per trade, not because they lack confidence, but because they understand variance. A strategy with an edge still produces losing streaks. Without controlled sizing, even a strong strategy collapses under normal drawdown. Livermore experienced massive losses in his career. But the lessons he left behind emphasized discipline in exposure. He learned that even correct market direction means nothing if leverage is misused. Leverage magnifies everything. It magnifies gains. It magnifies losses. But more importantly, it magnifies emotion. The modern trader has access to extreme leverage at the click of a button. This convenience is dangerous. Small accounts can control large positions. The illusion of power replaces prudence. Traders feel invincible during winning streaks. Then one sharp reversal erases weeks of gains. Livermore's rule was simple: never risk enough on one trade to jeopardize the ability to continue. Continuity is the hidden edge in trading. Those who survive long enough eventually refine their skill. Those who blow up never get the chance. Position sizing must align with structure. Stops should be placed where the trade idea is invalidated, not where the loss feels small. This often means the stop distance is wider than the trader prefers. The solution is not to tighten the stop. The solution is to reduce the size. This is where ego interferes. Reducing size feels like reducing ambition. It feels small. But in reality, it is professional. Large size on a weak foundation is gambling. Proper size on a strong foundation is speculation. Livermore pyramided his positions only after the market moved in his favor. This technique is misunderstood. He did not randomly add to winners. He added strategically when the market confirmed trend continuation. The key principle was simple. Risk increases only when probability improves. Most traders increase size after wins out of excitement. Livermore increased size only when structure justified it. There is a difference between emotional scaling and strategic scaling. Another crucial element of position sizing is consistency. Risking 2% on one trade, 10% on another, and 1% on the next creates unpredictable equity swings. Consistency in risk creates smoother equity curves. Smooth equity curves preserve psychology. The goal is not to maximize one trade. The goal is to maximize longevity. Over time, compounding works in favor of disciplined traders. Small, consistent gains accumulate. Large, inconsistent swings destroy progress. Position sizing also determines recovery speed. A 50% loss requires a 100% gain to recover. Large drawdowns demand unrealistic performance to return to break even. Avoiding large drawdowns is more important than chasing large returns. Livermore understood that being wrong is part of the game. He accepted losses quickly. Small losses were tuition. Large losses were unacceptable. The difference between amateurs and professionals is not win rate. It is loss control. Consider two traders with identical strategies. One risks 5% per trade. The other risks 1%. After a series of 5 consecutive losses, the first trader is down significantly and emotionally shaken. The second trader remains stable and objective. The strategy did not change. The position sizing did. Stability creates clarity. Clarity allows execution. Execution produces results. Position sizing also protects against overconfidence. Winning streaks create psychological inflation. Traders feel smarter than the market. They increase size aggressively. When the inevitable losing trade arrives, damage is amplified. A fixed percentage risk model prevents this spiral. It keeps exposure proportional to capital. As equity grows, position size increases naturally. As equity shrinks, size decreases automatically. The system enforces humility. Livermore's greatest campaigns were built on patience and scaling into confirmed moves. He waited for the market to prove him right before pressing. He never pressed hope. Hope is not a strategy. Position sizing transforms trading from gambling into structured risk management. It creates boundaries. Within those boundaries, discipline thrives. The irony is that smaller size often leads to larger profits over time, not because individual trades are bigger, but because consistency compounds. Many traders search for the secret indicator. Few search for the correct size. Yet size determines whether a trader survives long enough to see their edge play out. In volatile markets, this principle becomes even more critical. Volatility expands ranges. Stops widen. Emotional pressure increases. Without adjusted sizing, volatility becomes destructive. Livermore thrived in volatile conditions because he respected them. He did not fight volatility with oversized positions. He adapted size to match environment. Adaptability is strength. Position sizing is not static. It must reflect market conditions, account size, and psychological tolerance. A trader who cannot sleep because of open risk is trading too large. Peace of mind is an underrated metric. Professional trading is boring by design. Controlled risk reduces drama. Dramatic trading produces dramatic outcomes. The key to position sizing is understanding that trading is a long-term endeavor. There is no single trade that defines a career. But there are single trades that can end one. Livermore's rule was rooted in survival. Protect capital first. Increase exposure only when justified. Cut losses without hesitation. Let profits justify expansion. In the end, position sizing is not about mathematics alone. It is about character. It tests patience, humility, and restraint. Most traders fail not because they are wrong about direction. They fail because they were too large when they were wrong. The market will always produce uncertainty. Risk can never be eliminated, but it can be controlled. And in trading, control is power. Those who master position sizing stop fearing losses. Stop chasing gains. They operate within defined limits. Over time, those limits create freedom. Jesse Livermore did not become legendary because he predicted markets perfectly. He became legendary because he understood exposure. The key to longevity is not brilliance. It is discipline in size. and that discipline begins before the trade is ever placed. There is a difference between being right and being right at the right size. Most traders believe that if they can predict direction of the market, profits will follow automatically. But direction without proper scaling is fragile. A correct idea executed at the wrong size can still destroy an account. Jesse Livermore understood this better than most. His real genius was not prediction, it was positioning. Livermore did not begin with massive exposure. He began with a probe, a small position, a test, a question asked to the market. He allowed the market to answer before committing fully. This is the psychology of scaling in, the art of building size only after confirmation. It is one of the most misunderstood and misapplied principles in trading. Most traders scale into losing positions. They call it averaging down. They justify it as improving price. But Livermore warned that adding to a losing trade is like throwing good money after bad. When the market proves you wrong, the correct response is reduction, not expansion. Scaling in, as Livermore practiced it, meant adding only when the market moved in his favor. This distinction separates professionals from gamblers. When a trader enters a position, uncertainty is at its highest. The idea is unproven. The direction is not confirmed. Emotional excitement is also at its peak. This is precisely the moment when size should be smallest. A small initial position reduces psychological pressure. It allows objectivity. If the trade fails quickly, the loss is manageable. If the trade begins to work, confidence increases naturally. Not from ego, but from evidence. Evidence matters. Livermore believed that markets reveal strength through continuation. When price moves in the anticipated direction and consolidates constructively, that is information. When it breaks into new territory with volume and participation, that is confirmation. Confirmation justifies addition, but addition must be structured. Scaling in does not mean doubling size recklessly. It means building progressively, step by step, as the market reduces uncertainty. Each addition should occur at logical technical levels, breakouts, pullbacks in trend, or structural continuation points. This transforms exposure from a guess into a campaign. Livermore thought in campaigns, not trades. A campaign begins small and grows as the market proves alignment. This method achieves two powerful objectives simultaneously. It limits early risk and maximizes exposure during momentum. Momentum is where large profits live. Most traders enter full size at the beginning of a move. If the trade works, they hesitate to add because they fear giving back profits. If the trade fails, they add out of desperation. Both behaviors are emotional distortions. Scaling correctly requires emotional neutrality. It requires accepting that the first entry is not meant to be the largest. It is meant to test the waters. If the waters are calm and flowing in your direction, you increase sail. If the waters are turbulent and against you, you retreat. The psychological strength of scaling lies in alignment. When traders add only after profit, they build confidence without increasing stress. The market is already paying them. Risk becomes partially funded by unrealized gains. This creates psychological cushioning. But scaling also demands restraint. Not every winning trade deserves addition. Some moves are short-lived. Some are news-driven spikes. Livermore emphasized waiting for real continuation, not temporary excitement. Patience protects capital. Another key principle in scaling is spacing. Additions should not be clustered emotionally. They should follow structure. For example, after a breakout, wait for a consolidation or pullback before adding. This ensures that size is built within trend rhythm, not emotional impulse. This rhythm matters. Markets move in waves: expansion, consolidation, continuation. Scaling should mirror this natural flow. Adding during expansion and pausing during consolidation align size with strength. There is also the psychological impact of trailing risk. As a position grows, stop-loss levels can be adjusted to protect accumulated profit. This converts open risk into locked-in gains. Livermore, he often tightened risk as campaigns matured, ensuring that one sharp reversal would not erase the entire move. This discipline is what separated him from traders who made money and lost it just as quickly. Scaling in also addresses one of the greatest fears in trading: missing out. Fear of missing out drives traders to enter large positions prematurely. They want maximum profit from the very beginning. Scaling offers a rational alternative: enter small, participate, add if proven right. This removes urgency. Urgency is the enemy of clarity. Another overlooked benefit of scaling is adaptability. Markets change character. Trends accelerate, stall, or reverse. When full size is deployed immediately, flexibility disappears. When size is built gradually, adjustments are easier. If the trend weakens early, only small exposure is affected. Adaptability increases survival. But scaling must never violate the foundational rule of total risk control. Total exposure across additions must still fall within predefined account risk parameters. Scaling is not an excuse for over-leveraging. It is a method of distributing risk intelligently. Many traders misunderstand this and end up overexposed late in trends. They keep adding aggressively, even as structure deteriorates. This transforms strategic scaling into emotional chasing. Livermore avoided this by respecting market tone. When momentum slowed or volume shifted, he stopped adding. He observed. He protected. Scaling in is not about greed. It is about alignment with probability. Probability increases when price confirms direction through higher highs, higher lows, or lower highs, and lower lows in downtrends. Each structural confirmation reduces uncertainty. Reduced uncertainty justifies increased exposure. The psychological benefit compounds. Instead of fearing pullbacks, the trader anticipates them as opportunities for structured additions. Instead of panicking during consolidation, the trader sees preparation. This transforms mindset from reactive to strategic. There is also a mathematical advantage. When scaling into a trending move, average entry price may not be optimal, but total exposure captures the majority of the move. Instead of trying to predict the exact bottom or top, scaling captures the middle, the most reliable portion of trend. The middle is where consistency lives. Livermore understood that catching extremes is seductive but unnecessary. Large fortunes were built by riding confirmed trends with increasing conviction. Conviction built on evidence, not opinion. Scaling also reduces regret. When traders enter full size at once and the trade works, they feel relief. When it fails, they feel devastation. Scaling smooths emotional volatility. Small initial wins create satisfaction. Gradual additions build confidence. Losses remain manageable. Emotional smoothness leads to better decisions. One of the greatest dangers in scaling is ego. After a few successful additions, traders may believe they have mastered the market. They may abandon stop discipline or overextend size. Livermore himself experienced periods of overconfidence that cost him dearly. His later writings emphasize humility. No matter how strong the trend, markets can reverse unexpectedly. Scaling must always coexist with protective exits. The final piece of scaling psychology is acceptance of imperfection. Not every addition will be perfectly timed. Some will experience minor pullbacks. That is normal. The objective is not perfection. It is structured participation in sustained moves. Sustained moves create disproportionate returns, and disproportionate returns require increasing exposure at the right time. Not at the beginning, not at the end, but during confirmation. Most traders either bet everything at once or hesitate entirely. Scaling creates a middle path. It balances caution with ambition. It respects uncertainty while embracing opportunity. Jesse Livermore's greatest successes were not single trades. They were campaigns built patiently, layer by layer, as markets proved him right. He understood that size should follow strength. This is the rule: start small, add when confirmed, protect accumulated gains, never add to weakness, never violate total risk limits. Scaling in is not about aggressiveness. It is about synchronization with market behavior. When done correctly, it allows traders to build large positions without catastrophic exposure. It turns momentum into leverage without turning leverage into danger. In the end, scaling is a psychological discipline disguised as a technical method. It demands patience, humility, and structure, and those who master it discover something powerful. You do not need to be bold at the beginning. You need to be bold when the market proves you right. Most people believe fortunes in the market are made by bold predictions. They imagine a trader identifying the exact top before a crash or the exact bottom before a rally. They picture courage, instinct, and dramatic conviction. But history tells a quieter story. The real fortunes were not built on ion. They were built on survival. Jesse Livermore is often remembered for his massive profits during market collapses, especially the crash of 1929. But what separated him from thousands of other traders who also anticipated opportunity was not simply timing. It was risk control. Livermore understood something most traders never fully accept. The market can remain irrational longer than a trader can remain solvent. Being right too early is financially identical to being wrong. This is why risk control was not just a tool for him, it was the foundation. Before entering any major position, Livermore defined his exit. He knew exactly where he would admit he was wrong. This level of clarity removed hesitation. When the market invalidated his thesis, he did not argue. He exited. Most traders do the opposite. They enter with excitement and define risk later. Stops are moved. Losses are justified. Hope replaces discipline. Over time, small mistakes compound into catastrophic damage. Livermore treated losses as tuition. He accepted that losses were part of the business, not evidence of failure. But he also believed losses must be small. Small losses preserve capital. Preserved capital preserves opportunity. Opportunity is useless without capital. One of Livermore's core principles was never risking too much on a single idea. Even when conviction was high, he respected uncertainty. Markets are complex systems influenced by forces beyond any individual's control. Political shifts, economic reports, liquidity changes, all can disrupt even the strongest setup. Risk control acknowledges this unpredictability. It is not pessimism, it is realism. Another misunderstood aspect of Livermore's approach was emotional neutrality toward money. He did not measure trades by dollar amounts. He measured them by correctness of execution. When traders focus on money, fear intensifies. When they focus on process, discipline strengthens. This shift in focus changes behavior. Risk control begins with position sizing. Livermore never allowed a single position to threaten his overall survival. If stopped out, the loss would be meaningful enough to respect, but small enough to recover from. Recovery is critical. Large losses require exponentially larger gains to recover. A 50% loss requires a 100% gain to return to break even. Livermore understood this mathematics intimately. Avoiding large drawdowns was more important than chasing extraordinary returns. He was patient with opportunity but ruthless with error. When a trade moved against him, he did not average down. He did not increase exposure in hope of a rebound. He believed the market was sending information. If price contradicted his thesis, the thesis was wrong. This principle saved him countless times. Traders often fear being stopped out just before a reversal. This fear leads them to widen stops irrationally. Livermore accepted that occasional premature exits were part of disciplined trading. What mattered was consistency over time. Consistency compounds. Another key element of his risk philosophy was waiting for confirmation. He did not act on anticipation alone. Acting too early increases uncertainty. Waiting for confirmation reduces it. Reduced uncertainty lowers risk. This patience also filtered low-probability trades. Livermore did not need constant action. He waited for conditions that aligned strongly with his framework. When conditions were unclear, he preserved capital. Capital preservation is power. Without capital, even the best opportunity is meaningless. With capital, patience becomes possible. Many traders misunderstand leverage. They see it as a tool for faster growth. Livermore saw leverage as controlled exposure. Used responsibly, it amplified winning campaigns. Used recklessly, it destroyed accounts. He had experienced both outcomes. His early career included massive gains, followed by devastating losses. Over time, he realized that talent without restraint leads to volatility. Restraint without talent leads to stagnation. The balance between the two creates longevity. Longevity builds fortunes. Risk control also includes emotional control. When traders risk too much, emotions intensify. Fear distorts judgment. Greed accelerates decisions. Proper risk sizing keeps emotional responses manageable. Manageable emotions improve execution. Execution determines results more than analysis. Livermore also respected market tone. Even if his thesis remained valid, if the market behaved erratically or lacked follow-through, he reduced exposure. He listened to behavior, not just ideas. Behavior reveals strength or weakness when markets confirmed. His direction, he increased size strategically. When markets hesitated, he protected gains. This dynamic adjustment is advanced risk management. Risk is not static. It changes as markets evolve. Another powerful concept Livermore practiced was sitting tight with winners, but not with losers. Many traders reverse this rule. They hold losing trades hoping for recovery and take quick profits out of fear. Livermore did the opposite. He cut losses quickly and allowed profitable trades to expand. This asymmetry creates positive expectancy. Small losses combined with larger wins produce growth over time. Growth built slowly is sustainable. Sudden gains built on excessive risk are fragile. One of the hardest lessons in trading is that survival precedes success. Traders who risk aggressively may experience rapid gains, but they also increase probability of collapse. Livermore's legacy endured because he prioritized survival. Even after losing fortunes, he rebuilt. Why? Because he understood risk deeply enough to adapt. Adaptation is survival. Markets evolve. Strategies evolve. But risk principles remain constant. Define exposure. Accept uncertainty. Cut losses. Let strength confirm size. Livermore also understood psychological resilience. Large drawdowns can damage confidence permanently. By limiting risk, he preserved not only capital but belief in his system. Belief fuels discipline. Without belief, traders abandon strategies prematurely. With disciplined risk, even losing streaks are tolerable. Confidence remains intact because losses were expected and controlled. Another overlooked element of his philosophy was not forcing trades. Forced trades arise from impatience or desire for action. Risk increases when trades are taken without strong alignment. He waited. Waiting reduces unnecessary exposure. Fewer trades mean fewer mistakes. High-quality trades justify risk. Low-quality trades waste it. Risk is a resource. Like capital, it must be allocated wisely. The myth of the fearless trader is misleading. Livermore was not fearless. He was structured. Fear exists in all markets. Structure channels it productively. When risk is predefined, fear becomes manageable. When risk is undefined, fear becomes overwhelming. The true secret behind big fortunes is not extraordinary bravery. It is extraordinary discipline. Livermore's greatest strength was not predicting crashes. It was controlling himself. Control over self precedes control over capital. In the long run, markets reward those who protect downside more than those who chase upside. Upside takes care of itself in strong trends. Downside requires deliberate defense. Defense wins longevity. Longevity creates compounding. Compounding builds fortunes quietly. Livermore's life was complex and filled with both triumph and tragedy, but his principles remain timeless. Risk control is not glamorous. It does not make headlines. It does not excite beginners, but it separates survivors from casualties. In every trade, there are two decisions: where to enter and where to exit if wrong. Most traders obsess over the first and neglect the second. Livermore reversed this focus. He respected the exit more than the entry, because he understood that in markets, survival is victory, and victory sustained over time becomes legend.